Meanwhile, we've pulled hundreds of thousands of dollars out of the market just last year with this methodology. New to the channel? What's up? My name is Cleveland, and I worked as a professional trader and analyst for 6 years. And now I'm here to bring you my daily insights on business, capital markets, finance, and more. Enjoy the video and welcome to the channel. There is thorough documentation that shows that the best trading strategies are the ones created by the mathematicians, right? What Jim Simmons has done over at Renaissance Capital, what Kenneth Griffin has done over at Citadel, these are the best performing traders to have ever existed, and they all have backgrounds in mathematics, physics, computer programming, so on and so forth. But where does that leave the retail trader who is at the whim of just using their own discretion? They don't have any real technical background, right? And all they can really do is use some type of technical analysis, maybe do some research in regards to the economics, and that's the best they got. Well, we do know that most retail traders fail at this, right? With 97% of all retail traders who have ever existed have never made more than $10,000 in a trade, in a portfolio, in any span of time. But there are many institutions that trade with using their own discretion, like Bill Ackman's trade back in 2020, where he grossed over $3 billion on 23 million bucks. That was a discretionary trade where he was looking at the economics, where he then pulled those ideas into actionable trading decisions that made him lots of money. You also have Michael Burry in 2008, a full discretion trade, no automation. He just did research. And I want to bring you guys the scientific FX trading methodology that those guys used. And back when I used to work at Loma Management Partners, we used that same methodology as well. So, all right, guys, this is all based off of the scientific method. If you guys don't remember what the scientific method was, it was a way that you did experiments back in high school, maybe in college, that helped you come to a conclusion. And that's exactly what this methodology is all about. And I'm going to be walking you through this entire process from start to finish. Okay, so if you guys do enjoy this video, make sure you guys like the video. I very much appreciate it. All right, I want to put out this risk disclaimer. This is what you call a professional trader development program, right? So this is what I went through, but it took 6 months for me to complete this after I left university. And this is basically just the framework. So it's not everything. So I don't want you guys to run away with this and think that, okay, you can just go off and become a super trader. This is the framework, and you're going to have to plug your own system into it or use your mentor system or your buddies or whatever. All right. So let's look at the overview real quick. This is what we're going to be discussing today, from the introduction all the way down to post-trade analysis, looking at the positions that you've taken. Okay. So how does this work? The only way this can work is if you use fundamentals and technical analysis, right? I've made countless videos on this, but just know you can never trade profitably long-term without using fundamentals. You have to use fundamentals in some context. Here I've mentioned, and by the way, you can download this entire presentation. The link will be in the bio. But here I mentioned that 97% of all Forex volatility and price trends comes from fundamental scenarios, right? When you look at the collapse of the Russian ruble or the collapse of the euro or the collapse of the yen last year, we've never seen the yen down at the levels where it was at. 40 years, it hasn't been down at those levels. That didn't happen because of technicals, that happened because of the fundamentals. And you have to have a fundamental bias that then you can fit a technical framework or a technical system on top of that. And we're going to be discussing that here today. Technicals are for your trading parameters, your entry, your exit, and your stop. That's it. All right. So how does the scientific method work? Well, we know we have to observe or ask a question. After you ask that question, you research details about that question / industry / topic. You formulate a hypothesis, you test that hypothesis, you analyze the data, and you report conclusions. Now, how does this work as it relates to capital markets? Well, here I mentioned that in capital markets, you're researching, analyzing, and interpreting data every single day. So you can fit any type of trading activity perfectly into the scientific method. Here is how that works. Okay, so first you ask the question, could this pressing event / scenario impact capital markets? So last year, for example, we were looking at the Russian invasion in Ukraine. That's the question we ask. We're observing markets on a daily basis, looking at all the latest headlines and different articles that are coming out. And then boom, we get hit in the face with this idea that Putin's going to invade Ukraine. And we knew that this was going to cause a very dramatic shift in capital markets, but we had to understand first what asset class was going to be affected most. So the way you start this off is you create a routine where you're reading, again, the latest articles, the latest headlines, and you have to stay up on what's happening in the world economy. Because remember, 97% of all price action is driven by fundamentals. So you have to know what's happening fundamentally. Okay. From there, you have to isolate a story that you believe is going to be heavily impactful to capital markets. And then once you isolate that story, you start to do research on that particular topic. All right, so here's a great example. Again, Russian invasion causes global market panic. But what was interesting was we didn't see markets react quickly, right? Russia invaded Ukraine February 24th, yet Putin was threatening to invade Ukraine all the way back in mid-January. So you see that when you trade in this capacity, it takes a little bit longer for the institutions to have that verifiable truth that, hey, this invasion is happening. We need to get some size in on this position right now. And here you go. As you guys can see, on the 24th, we get the invasion and then we get the collapse of the euro. But previously, before then, we were getting lots of information about this potentially happening, and we never had a collapse of the euro. So with this strategy, you ask your question, you do your research, and then you can start to formulate hypotheses. But this is how you do your research. All right. So first, gather relevant information and resources related to that specific event. 3 parts of this. You go deep into that event. Why the hell is Putin invading Russia? We have to figure that out, right? We then back test. We look at other instances where turmoil and rift between 2 countries have affected capital markets in the past, but then we slowly start to isolate those variables, because just because there's a war happening between 2 nations doesn't mean it's going to affect capital markets. We have to understand why this war is going to affect capital markets and what capital markets, what asset classes is it going to affect? And we do that by isolating the variables, figuring out what's different about this war relative to all the others. This is how we do our research. Okay, so how do we do our research personally? Well, my primary resource is Discord, because when you have a bunch of intellectually inclined, event-driven traders that are looking for certain economic events, all communicating, it gives you a real solid edge on making sure you know what's happening quickly. We also have something called TraderBot that really helps us understand the headlines that are coming out, and it's all through automation. So cool stuff like that can help a lot as well. Certain squawk boxes are pretty popular. You guys can research what a squawk box is. There are a couple of popular ones out there, but I don't see them as really necessary. I think if you can create a system like a Discord or some type of RSS feed that only pulls high-level headlines, you're going to be much more effective. Now, from there, I love Seeking Alpha. Seeking Alpha is a great resource because it's institutional traders and money managers posting about what they see happening in capital markets. And then, of course, you have financial media, Financial Times, Bloomberg, Market Watch, and Twitter is also a great place to really get some details and maybe follow some guys that are on the ground floor of certain financial situations, right? They're merger and acquisition reporters on Twitter, like that are specifically focused on that area of finance, examples like that. Okay. So once you pose your question, then you do your research and you gather that research, you get all that information. Based on that data, you create a hypothesis. This is the 3rd step to this entire methodology. There are 5 different areas: the certainty you have of this event playing out, the size of the event, how substantial is it going to be, what would invalidate this event to happen, how are you going to manage money around this scenario, in your trading parameters. Okay, define your entry, stop, and target. Now, this right here is the most difficult part of the entire process. Anybody can read a headline, anybody can do research, but gathering that research and putting together a legitimate hypothesis, a legitimate trade idea, this is the part that spooks a lot of people from using this methodology. They would love to simply just go on TradingView and draw a bunch of crap on the chart and just hope and pray that that conspiratorial trading strategy that they just came up with, or that they read about on the internet, or they saw some guy use on Instagram, they hope that that's going to take them to financial freedom. But again, this is why 97% of retail traders never make any money. Meanwhile, we've pulled hundreds of thousands of dollars out of the market just last year with this methodology. Okay, so read through this, download this PDF, and you can look at these things. But this is the most important part. What is your hypothesis, right? How much capital are you going to risk based on this scenario, based on the certainty of you think it playing out? All right, I've mentioned this a lot on my channel, but there's something called the Kelly criterion that most money managers use that basically say during heightened times of probability, you risk more capital. We knew that Russia was going to invade Ukraine. It was obvious. Before February 24th, he was literally marching towards the border for like 2 weeks before it happened. So we put on a pretty sizable bet and it worked out very favorably, right? So taking the trade. Now, once you take the trade, once you've done your hypothesis, this is actually a simple part, but psychologically, it's the most stressing, okay? And this is where, again, a lot of traders break down because you really only have two things you need to worry about during this part of the method, okay? You manage that trade and the trade is over, okay? So a lot of times people think that when it comes to managing a trade position, there is all these intricacies and all these things that you have to do once you take it, and then as you're taking it, and then after you're taking it, there's like this big chunk where they think that you're supposed to be moving the stops all over the place, putting on more positions, blah, blah, blah. No, you are supposed to define your risk before you get into that trading opportunity based on the certainty that you think that particular trade is going to play out. Now, how you start to expose your capital to that particular trade setup, that's completely up to you. Imagine you're risking $10,000 on a trade. You may start off by putting on $2,000. You may then scale up to put on another $3,000. Now you're at $5,000. And by the time maybe your certainty and you see that this trade is really going to pan out and the market is still moving in your favor, you may have your full position on, right? There are definitely methodologies like that, and ours incorporates that internally. We have something like that, but that's the most complex this thing really gets. And then the trade is over. Now, this part is a little sticky, the trade being over, that I want to move over to the next slide. Taking the trade in the scientific method, you could look at this as the test/experiment part of the scientific method. Now, post-trade analysis, after your test/experiment/trade that you took, you're supposed to do your analysis of the process. Okay, so this is the fifth part of the scientific method out of 7. All right, so what was the magnitude of that trade? What was the direction? Were you correct in your assumption? Your initial hypothesis, you had a directional bias. Well, do your post-trade analysis. Were you correct in that directional bias? And then retrospect, right? Did the event play out the way you thought it would? Okay, when Russia invaded Ukraine, did you think that it was going to be quick and then capital markets were just not going to be affected by it? Or did you perceive that it was going to be a month-long drawn out, or year-long now drawn out scenario? Which is the case? Which is why the trade over is important, because a lot of times traders get out of a trade too early, right? We see that right now, the euro, if we take a look at the euro really quickly here, you guys will see that the euro is still being affected by what we see happening in Russia and Ukraine. But there's quite a sizable pullback that has recently happened. Okay, so you guys can see that right here. This is where Russia invaded. We sold off quite dramatically. We pushed to the upside, and then there was another subsequent invasion. And we've just traded a lot higher back up into that range again, mainly because there were fears that Europe was going to go into recession, but that actually never ended up happening, right? And so what we see is just a rebound happening where technically that trade is kind of evaporating. It's not that it's becoming unsubstantiated, right? Because the war is still going on. It's just that there's a lot of positive things happening in Europe right now that's really creating a very interesting scenario, because if this war escalates, then that entire leg of that euro up move is going to collapse, right? So we're keeping an eye on that. But overall, is the trade over? I wouldn't say that the Russian invasion trade is over. I think it's more at a pause right now until we can see exactly how things are going to unwind. Now, how long did time elapse? Okay, post-trade analysis. How long did it take for this trade to unwind? Or are you still in it? And is it a redefining trade? Does it redefine the asset itself? This is really important. For example, Zoom back in 2020, all right, that was a redefining scenario, COVID, because it changed the nature of Zoom, the company, the video chat software, forever. Okay, and now people are going to be looking at Zoom and using Zoom in a completely different way because of that fundamental catalyst, because of coronavirus. Okay, so after that, you're going to be doing an evaluation. Once your post-trade analysis is done, you then create a quick synopsis of that entire experiment, okay, that entire trade, and then you're supposed to log that information. And that's where you start to build out your portfolio or your journal and things of that sort. All right, so that's the full methodology from start to finish, okay, where you first start to think of a question. You ask yourself a question regarding a particular scenario in the economy. All right, whether it's politics, whether it's something that dealing with a commodity, whether it's something that dealing with trade relationships, capital markets in general, the economics, and then you slowly go through that process of doing research and then creating a hypothesis. And then based on that hypothesis, right, how likely do you think it's to happen? How much size are you going to go in? What's the directional bias that you think is that a particular scenario is going to end up pointing capital markets in? You take the trade. Once you take the trade, you get out of the trade, okay? You got to do some post-trade analysis, okay? And then from there, you evaluate and then you log your results, all right? So this is a very bulletproof way that you can throw in any methodology. I know in this instance, I was heavy on the fundamentals with the technicals being at the front end, okay? Because that's just the way that I was brought up. I've never seen or I've never really met someone super successful that was a technical guy. Most of the guys that I've ever worked with and that I've ever seen in real life at the institutions, at all the different banks that I've ever visited or worked at, they all use fundamentals to a very high capacity. I've never seen a professional guy kill it with technicals. So I'm just going to do what I see works. So I go heavily on the fundamentals. I use the technicals for my trading parameters, and then I move forward just like that. All right. So take a look. Here's the conclusion. This entire presentation, the link is down in the bio. I got some recommendations for you. Head to Trading Economics to learn a little bit more about all these different economies and all the different economic reports that are put out there. It's going to be really important. Study, okay? If you guys need to learn or have a better understanding of how to use economics or to get more economic resources, head over to toptrader.io. There's going to be a lot of resources there for you as well, okay? So that's it. All right, that's the scientific FX methodology. Let me know what you guys think about that. It's been extremely helpful to me and all of the people that are inside of the Top Trader community and everyone that I've ever worked with in this crazy business. So let me know what you guys think, all right? Talk to you guys soon. Peace out.